The CEO and chairman of Berkshire Hathaway, Warren Buffett, is a genius at investing if we know anything about him. Despite making substantial donations to charity, Buffett is the fifth richest person in the world, and plenty is to be learned from him. Warren Buffett adheres to the value investing philosophy, purchasing undervalued companies and holding on to them over the long term. He and his business have been able to navigate periods of inflation and economic downturns with remarkable ease thanks to their investment philosophies. Welcome back, everyone. In today's video, we'll be sharing 5 rules of investing. Remember to like and share this video. In addition to adhering to the value investing theory, Buffett also has a set of guidelines for choosing the best businesses to invest in. Buffett is adept at generating profits on his stock investments, and if you adhere to his guidelines, you might also learn how to do it. Buffett has had a flawless career in the stock market, but that doesn't mean he hasn't occasionally suffered financial setbacks. Buffett personally lost about $23 billion while his company's profits fell by 62% during the same period. Buffett's experiences should teach you that investing takes continual learning and that picking the right firms to invest in ultimately comes down to taking calculated risks. It would be best if you did extensive research on the stock you intend to invest in and used your best judgment when making purchases. Hopefully, you'll be on the road to succeeding as the world's next investment tycoon. Investors haven't had it easy this year, and many people are worried that a recession may be on the horizon. Nobody can predict with certainty whether or not there will be a recession, but since market declines and economic downturns frequently coexist, stock prices may continue to decline. Let's dissect these rules and see how we may use them to guide our financial choices. Number 1. Rule number 1. Never lose money. Rule number 2. Never forget about rule number 1. For Buffett, this is the first and most crucial investment guideline. This rule is more about an investor's mentality than market moves. Even Warren Buffett can experience loss, but that doesn't mean you couldn't either. He is better than most at living cheaply, though. He has been in the same home since 1958 and always gets McDonald's in the morning. His extravagant spending habits are a cautionary tale for anyone wishing to invest like him and for entrepreneurs. We must exercise caution when spending our money to become wealthy and maintain it, like Warren Buffett. Number 2. Never invest in businesses you cannot understand. In the topic of crypto, Buffett is wary of investing in ventures he needs to comprehend fully, even saying, "I get in enough trouble with stuff I think I know something about." He has gone to extremes. Why should I invest in something I don't understand by taking a long or short position? Using this guideline, he advises investors to focus on protecting their investment by picking businesses and goods they are well versed in. While certain businesses or projects may appear to be very profitable, it is unwise to invest in them if you don't completely understand what they want to achieve. Number 3. Our favorite holding period is forever. Buffett has a track record of identifying well-rounded businesses and sticking with them for a long time. For instance, Berkshire Hathaway has held on to its Coca-Cola investment for 34 years. After accounting for reinvested dividends, Coca-Cola's stock generated returns for Buffett's firm of 5,810%, demonstrating the enormous value of holding on to the stock. Buffett's success with this approach makes it understandable why he recommends to others to follow suit. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes, he says. Number 4. Never invest in borrowed money. Buffett strongly advises entering the investment world only if you have the necessary funds. He claims that risking all you have and need for something you don't need is foolish. There can be instances where you observe a stock performing so well that borrowing money to invest in it seems like the best course of action. It would help if you kept in mind that buying stocks always involves some risk. Even if a stock may be performing well right now, if you purchase it with borrowed funds, its value could plummet and leave you in debt. Furthermore, you use borrowed funds to purchase stocks. In that case, your priority will be repaying the debt rather than developing a long-term plan to maximize returns, which contradicts the preceding guideline. Number 5. Be fearful when others are greedy, and be greedy when others are fearful. Faith without showing up results in nothing. Nothing good will happen to someone who stays in bed all day. Show up today. Maybe you need to make a phone call you're resisting. Make the move, go for it, fail and show up again. Fail and show up yet again. You'll figure it out. Just consider all the situations in your life that you've already survived. You were born into the world and survived, and you knew nothing when you got here. Look at what it took to create you, and you are here. If you're not first, you're last. Arrive first and be prepared. Get there first and get ready to kill it. And even if you did absolutely nothing but show up an hour early and just sat there for an hour before everyone else arrives, when people start to show up, they'll ask, "What is with this guy? What is he up to? What's he about?" Clear your head, get there early, get game ready. Buffett's final advice is to steer clear of investing with the crowd. You must rely on your market knowledge to succeed as an investor. Buffett is attempting to convey that the price will rise when many investors have favorable opinions about a certain stock. You would overpay for such stock and not receive comparable returns if you bought it. This brings up the concept of value investing, which is choosing equities with a high intrinsic value but currently trading at a lower price. It is crucial to remember that you shouldn't try to stand out, but rather follow your instincts rather than do as others do. Purchasing stocks during a tumultuous market can be nerve-wracking. It's not reassuring if you invest today, and stock prices drop because your portfolio can lose value immediately. However, the market's long-term success is far more significant than its ups and downs in the near term. Additionally, historically, it is a perfect record of rebounding from financial crises and economic downturns. Maintaining a long-term perspective amid a downturn might not be easy, but things will improve. No matter what occurs in the upcoming weeks or months, the market will likely experience long-term gains. A simple rule dictates my buying, Buffett continued in the Times piece. Be careful when others are greedy, and be greedy when others are fearful. Now is the moment to get greedy as stock prices keep declining. The market is practically on sale, and several stocks are trading for less than they have in years. This can be your chance to buy if you've been waiting for a cheaper time. For instance, Amazon has decreased by more than 51% from its high. It last experienced a drop of similar nature when recession fears caused a 60% decline. This expensive stock could represent a once-in-a-decade investment opportunity right now. In addition to being a wise time to store up on quality stocks at a discount, now is also a good time to do so since it can position you for huge gains when the market eventually rebounds. Of course, there are no assurances that you will experience this level of development. However, stocks from strong companies are much more likely to bounce back from a downturn, and by buying now, you'll be in a good position to benefit from that recovery. Investing is only sometimes simple when the market is declining, so it's understandable if you're experiencing some concerns. But if you invest wisely and stay committed through the market's recovery, downturns may be wonderful times to make money. According to Buffett's piece in the Times, "I can't predict the short-term movements of the stock market. What is likely, however, is that the market will move higher, perhaps substantially so, well before either sentiment or the economy turns up. So, if you wait for the robins, spring will be over." That's all for this video. We'll be back soon with another informative video. Remember to like and share this video. Until next time.